Afternoon, everyone. Thank you for joining us today. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and I'm excited to be here with you to talk about the tax consequences of selling your primary residence. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two tax clinics, the first of which is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS, and the second of which is our volunteer income tax assistance clinic, where we help prepare income taxes for free. Additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. I, Zach, am the outreach coordinator, and then Masood Chotani is the clinic director here at the Taxpayers Help Center. And then just a few housekeeping items before we get started. If you wouldn't mind, please keep your mic muted during the presentation so we can avoid any background noise. And then if you have any questions at any time during the presentation, please feel free to use the chat feature and I'll be sure to address any questions. So if you would like to connect with us, you may do so through email at info@taxpayershelpcenter.com, through our Facebook, Taxpayers Help Center Inc., a nonprofit organization. We also have our location at 9029 Reseda Boulevard, Suite 209, Northridge, California. Our website, taxpayershelpcenter.com, and then our phone number is listed here as well. And then if you have any questions at any time during the presentation, but you're watching a recording of it, you can email us at info@taxpayershelpcenter.com and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and those who can volunteer their time, expertise, or spread awareness are also a great help. So if you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or if you go to the taxpayershelpcenter.com website and click on the make a donation tab, which is circled in red here, that's another way to go find that part of the website. So again, anything is greatly appreciated as these donations allow us to do what we do. So today we are going to be talking about the tax consequences of selling your primary residence. So we'll address the following topics throughout the presentation. So does your home qualify for a partial exclusion of gain? We'll be figuring gain of loss, property used partly for business or rental. We'll talk about how much is taxable, reporting your home sale, and then how to get tax help. So first off, we're going to answer the question, does your home sale qualify for the exclusion of gain? So the first thing you need to know is the ownership and use test. This is pretty straightforward. So you must have owned and lived in the home as your primary residence for at least 2 years out of the last 5 years before you sell it. These 2 years don't have to be consecutive. You can spread them out over the 5-year period. So for instance, if you owned the home for 4 years but rented it out for two of those, you could still qualify it. You could still qualify if you lived in it for any two out of those 4 years. So now let's talk about the money part. The exclusion allows you to exclude up to $250,000 of the gain from your income if you're single. If you're married and filing jointly, that amount doubles to $500,000. This is a huge benefit, especially if your home has significantly appreciated in value. Essentially, this exclusion can save you a lot of money on taxes when you sell your home. Frequency limit. Here's something important to keep in mind. The exclusion isn't something you can use over and over again without limits. There's a frequency limit in place. You cannot have used this exclusion on the sale of another home in the last 2 years. So this rule makes sure that the exclusion is being used for genuine home sales rather than as a way to avoid taxes repeatedly. And then finally, there are some special considerations, or situations rather, where you might still qualify for a partial exclusion, even if you don't meet all the requirements. For instance, if you had to sell your home because of a job change, health reasons, or some sort of unforeseen event like a natural disaster, you can still be eligible for a prorated exclusion. So these exceptions are designed to give you a break if life throws something you don't expect and you're forced to sell your home under tough circumstances. Next, we're going to answer the question, Does your home qualify for a partial exclusion of gain? So if you don't meet the full eligibility test for the home sale exclusion, sorry, you might still qualify for a partial exclusion of gain. So this is essentially a reduced version of the full exclusion and is available under certain circumstances. It's a way to provide some tax relief even if you had to sell your home sooner than expected. So let's talk about some situations where a partial exclusion might apply. The most common scenarios include a change in employment that requires you to move, health issues that make it necessary to relocate, or an unforeseen event that forces you to sell. These circumstances are considered valid reasons for selling your home earlier than planned, and the IRS offers some flexibility here. So, how is the partial exclusion calculated? It's based on the amount of time you owned and lived in the home relative to the full 2-year requirement. Essentially, you take a fraction of the 2-year period that you did not meet and apply that fraction to the full exclusion amount. For instance, if you only met 1 year of the 2-year requirement, you might be eligible for 50% of the exclusion, which is $125,000 if you're single, or $250,000 if you're married, because 50% of $250,000 is $125,000 and 50% of 500,000 is 250,000. So let me give you a quick example. Suppose you owned and lived in your home for 1 year before you had to sell due to a job relocation. Since you met 50% of the 2-year requirement, you would qualify for the 50% of the full exclusion. So if you're single, that would mean up to $125,000 of your gain could be excluded from your income. So this calculation helps you still get some of the tax benefit even if you couldn't stay in the home for the full period. When figuring gain or loss on the sale of the home, it's all about the numbers. The basic idea is to compare the amount you sold the home for with your adjusted basis in the property. So if the selling price is higher than your adjusted basis, you have a gain, excuse me. If it's lower than your adjusted basis, then you have a loss. So this calculation is key because it determines whether you might owe taxes or if you can deduct a loss on your taxes. Now let's break down what we mean by adjusted basis. Your adjusted basis starts with the original purchase price of your home. To that, you'll add any significant improvements you made over the years, like adding a new roof, remodeling the kitchen, etc. These kind of improvements add to the value of your home and therefore increase your basis. You will add certain expenses related to the purchase, like closing costs, but if you use your home for business or rented it at any point, you'll need to subtract any depreciation you claimed during this time. This adjusted basis is what you'll compare to the sale price to figure your gain or loss. So now let's talk about calculating your gain. So to calculate your gain, you start with the sale price. This is not just the cash you received, but also includes any other property or services you might have received as part of the sale. For instance, if the buyer threw in a car as part of the deal, you would include the value of the car in your sale price. Next, you subtract your adjusted basis from that sale price. This step gives you your gain. If your adjusted basis is lower than the sale price, that difference is your gain, and that's what you will be working with when figuring out any potential taxes. So let's just look at an example really quickly. So suppose you sold your home for $400,000 and your adjusted basis in the home is $300,000. You'd subtract the $300,000 from the $400,000, which gives you a gain of $100,000. So this $100,000 is the amount you'll need to consider for tax purposes, and depending on your situation, some or all of it might be excluded from your taxable income. So on the flip side, if your adjusted basis is higher than your sale price, you've got a loss. This can happen if the real estate market drops or if you put more into the home than you can recover when selling. So unfortunately, if the home was your primary residence, you generally can't deduct a loss on your taxes. The IRS doesn't allow personal losses to be deducted. However, if if the home is used for a business or rented out, part of the loss may be deductible against some other income. So here's an example. Say you sold your home for $250,000, but your adjusted basis is $270,000. you would be left with a loss of $20,000. And while this loss reflects a financial setback, it's not something you can typically deduct unless the home was used in a business or rental capacity. Okay, so if you've used part of your home for business or rental purposes, things get a bit more complicated when it comes to taxes. When you sell a property that's been used partly for business or rental, you have to handle the gain or loss differently compared to a purely personal residence. The IRS considers the business or rental portion of the home as a separate asset, and that can impact how much of your gain is taxable. To figure out how much of the gain or loss is related to the business or rental portion, you will need to allocate the total gain or loss between personal use and business use. This is usually done based on percentage of the home that was used for business or rental. So, for example, if you use 20% of your home as a home office, then 20% of the gain or loss from the sale is considered business related and the rest is personal. And here's a key point. So if you've claimed depreciation on the business or rental portion of your home, you need to recapture that depreciation when you sell. This means that depreciation you've claimed over the years will be taxed as ordinary income rather than being excluded or taxed at the lower capital gains rate. This recapture can have a significant impact on your tax bill, so it is important to plan ahead for it. So let's go through some more examples to make this a little bit clearer. So suppose you've been using 25% of your home as a dedicated home office, and for the last few years you've been um, using that, and then now you're selling the property and you sold your home for $500,000. Your adjusted base income, excuse me, your adjusted basis in the home is $300,000. So normally you'd have a gain of $200,000, but since part of the home was used for business, we need to break it down. First, we allocate the gain between personal and business use. Since 25% of the home is used for business, 25% of the 200,000 gain, so $50,000, will be treated as the business gain. The remaining $150,000 is personal gain, and you might be able to exclude that under the home sale exclusion rules. But we're not done yet, so we need to consider the depreciation recapture. Let's say you've claimed $20,000 in depreciation on the home office over the years. This $20,000 will be taxed as ordinary income, not as capital gain because of the recapture rule. So in this example, the $150,000 personal gain might be excluded from your income if you qualify for the home sale exclusion. However, the $50,000 business gain is fully taxable and the $20,000 depreciation recapture will be taxed as ordinary income. So this mixed use scenario often leads to a higher tax bill than if the property were solely as a personal residence. Okay, so Form 8949 is the form you'd use when you sell your home, and you will have to report the gain or loss. So this form is where you'll list the details of the sale, including the sale price, your adjusted basis, and any expenses of sale. It's important to complete this form accurately as it's the basis for calculating your gain or loss. After you've filled out rather, the Form 8949, excuse me, you will transfer the information to Schedule D, which is where you will calculate your overall capital gains and losses for the year. If you have a gain, it gets added to any other capital gains you have, and if you have a loss, it can offset other gains or potentially reduce your taxable income. If you qualify to exclude some or all of your gain under the home sale exclusion rules, you'll still need to report the sale on Form 8949 and Schedule D. However, you'll only include the taxable portion of this gain, if any. This is crucial because it ensures that the IRS knows you've sold your home, even if you don't owe taxes on the gain. Reporting deductions related to your home sale. So when it comes to reporting deductions related to your home sale, the first thing to know is that you can deduct certain selling expenses. These include real estate commissions, legal fees, advertising costs, and any other expenses directly related to the sale of your home. These deductions are subtracted from your sale price, which reduces your gain and consequently your taxable income. Another important aspect is capital improvements. Any major improvements you made to your home, like adding a new roof, renovating a kitchen, or installing central air conditioning can be added to your adjusted basis. This increases your basis and reduces your taxable gain, so it's crucial to keep good records of these improvements. If you itemize deductions on your tax return, you might also be able to report some costs associated with selling your home on Schedule A. This includes things like mortgage interest and property taxes that you paid up to the date of the sale. It's a good way to potentially reduce your taxable income further, but remember only the portion of these expenses that aren't reimbursed or paid by the buyer can be deducted. Reporting other income related to your home sale. So sometimes a home sale doesn't go through and the buyer forfeits their earnest money deposit. If that happens, you'll need to report the forfeited money as income. It's considered taxable income by the IRS, so make sure to include it on your tax return. Another scenario is if you sell your home but then rent it back from the buyer for a period of time before moving out. Any rent you pay to the buyer is their income, but it's important to know that if you receive any payments during this period, those would be considered taxable rental income and should be reported on your return. And then don't forget about other types of income related to the sale. For example, if you provided seller financing and are receiving interest payments, that interest is taxable and should be reported as income. Any other proceeds from the sale that aren't directly a part of the sale should also be reported. So a few claims: first-time home buyer credit. When you bought your home and are now selling it within 36 months, you may be required to pay back some or all of that credit. The repayment is generally handled by adding the credit amount to your tax bill for the year in which you sell the home. And this can be a big surprise if you're not expecting it, so it's important to be aware of this rule. Similarly, if you've claimed any energy-related credits, like for installing solar panels or energy-efficient windows, you might need to recapture some of those credits if you sell the home within a certain period. The recapture amount typically reduces your gain, but it's still something you need to report. And for those repaying the first-time homebuyer credit, you'll need to fill out IRS Form 5405. This form is where you calculate the amount you need to repay and add it to your tax return. It's crucial to include this to avoid any issues with your tax filing. So if you need help with taxes, the IRS website, irs.gov, is a great place to start. You can find all the forms and publications you need. And then there's some also interactive tax assistance tools which can answer questions based on your situation. And then there's also the Where's My Refunds tool. So if you're checking on your refund status. And then there are also plenty of other resources to guide you through the process. And then also it's important to consider hiring a CPA, tax attorney, or enrolled agent for personalized advice if you need more personalized help. And then additionally, if you're looking for free tax assistance, there are also great options available. Programs like VITA, Volunteer Income Tax Assistance, and TCE, which is Tax Counseling for the Elderly, offer free tax help to qualifying individuals, especially those with low to moderate incomes, seniors, and people with disabilities. And then those volunteers are IRS certified and can help you prepare and file your tax return, ensuring you get all the credits and deductions you're entitled to. So let's quickly recap the key points from today's presentation on selling your primary residence. So if your sale qualifies, you can exclude up to $250,000 of gain if you're single, or $500,000 if you're married filing jointly. Remember, you need to meet the ownership use and frequency test the ownership use and frequency test to qualify for this exclusion of gain. Even if you don't meet all the tests, you might still qualify for a partial exclusion in cases like job relocation, health reasons, or unforeseen circumstances. And to determine your gain or loss, subtract your home's adjusted basis from the sale price. The adjusted basis includes your purchase price plus any improvements minus any depreciation. And then any gain that exceeds the exclusion limits or gain from non-qualifying portions of your property will be taxable. Report the sale using Form 8949 and Schedule D if necessary. Make sure to keep thorough records of all sale-related documents and calculations. And if you're unsure about any aspect, It's wise to consult with a tax professional or use IRS resources for guidance. So with that, that concludes our presentation. And again, since the services we provide are free, donations are crucial for our support and expanding our reach. Monetary donations are greatly appreciated, and additionally, those who can volunteer their time, expertise, or spread awareness are a great help. If you had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com, and your question will be addressed by a tax professional. So with that being said, thank you all for listening and have a great day.